Hey everyone, today I want to go over some individual stocks and look at the market, kind of give my outlook. I want to start today with SEZL. So, for some folks that know, I posted about SEZL at just about 100. Had a killer earnings. I was a little bit late to the party. Super nice linear run. I got out at about 164 just as it closed under the 10. For a couple of you who are familiar with kind of how using the 10 works, essentially, it's just the early sign of a trend change. So some people might sell if it's pretty volatile stock in price discovery and it closes under the 10. Now, oftentimes it'll actually be pretty good, but every now and then you'll get kicked out at the interim low, and I'll show you guys in a second. But SEZL is a really, really good company. Depending on how you look at it, like a lot of people think it's like subprime stuff, low quality, but this is one of the only buy now, pay later companies that's profitable. And it's not recent, they've been profitable for a couple of years. They're actually doing very well. The next quarter, they're probably going to kill the earnings. There's some sort of thing that does channel checks on it. I don't actually have all the details, but it's pretty accurate for quarter one on that beat. Looking back on it, and it's going to be quite a big beat for quarter two is what they're forecasting. So as much as I like this one, right now I'm kind of sidelined. I would have really liked to buy it in the 116 area, but the market conditions are a little bit too strong, risk on. For the most part, I try to stick to my strategies and not get too euphoric and chase around. So as much as I like this, I can let it go. That's just me though. At the end of the day, if you guys are just looking for a very good stock, that'll probably double in a year. This is probably it. How you want to find that entry is up to you. And then I'll jump to P6. This was one I called out a few times, and it was a really disappointing scenario because I read the 10, first close on a 10. Normally the 10 kind of glides and catches up. This is a really kind of painful scenario because the day it closed on the 10 was a minus 13% day, and the previous was like a minus 6, so it was pretty nasty. And I knew I had this support here. It was front running the 20. I was asking myself, well, should I break my rule and hold it? And I said no, and obviously it was a mistake, but you got to stick to your rules. I think the main thing that was really painful is like a very similar scenario happened on AppLovin. And it closed under its 10 after, some sort of a decentish run. After it got stiffed by the S&P 500. And what ended up happening was I also had a similar support. It was at the 20. And unlike P6, which was an interim low and bounced, this one unfortunately fell. So I held on to this one like a fool, thinking like, oh, is a little bit too quick. It's going into a support, going into a key average. Let me give it a chance. Obviously, that was wrong. Being more strict on myself the next time with P6, well, of course, my lesson in app was, kind of a reverse lesson, I guess, for P6. Not that I'm going to change anything in the future, I still do plan to be pretty strict on it. App was kind of like a weird one-off that I shouldn't have done, and I got punished for that accordingly. But yeah, for the most part, like I still will be using the 10 as a guideline. Something I want to bring up is IREN. IREN is a very hot retail stock. I wouldn't say I'm bearish, I wouldn't say I'm bullish. But why I do want to bring it up is these kind of retail-ish stocks that are not too horrible, not very great. They're kind of like weeds, you can't really get rid of them. Like they'll die, but then they'll sprout right back up. And I say this because these volatile kind of weedish stocks are actually extremely good to sell options on. So I'm going to try to run some sort of conservative wheel on this one. And I've already started. But essentially, like the premiums are so good to the point where as long as this stock doesn't, fall too linearly, or essentially disappear within the next 25-ish weeks, you can definitely find a way to essentially make triple digits returns with some sort of wheel strategy. So not that I plan to go too huge with it. As I mentioned, I want to go pretty conservative. I do think that this one is probably a pretty good one to run it on, just because, like, it's not too slow, and I don't think it's gonna suffer too much. Like, this one will be really bad in a correction, but that's not too much of a worry when you're running the wheel, and in some ways it might even be good. It's a little bit of a painful market. Like, a lot of the lowest quality companies are kind of rallying, so if you do kind of care about quality, it's not the best market. But at the same time, um these animal spirits, like, it does open up a lot of other opportunities, so something to note. MRVL is something I wanted to talk about. This one's been like probably the only chip stock that's been doing bad. So it's pretty shameful to say that I'm actually bullish on this one, and it's the only one I'm actually long. So, it sucks to be me, I guess. But I guess, like, still, reiterating the same points. If you guys have been waiting, I guess this is probably a good entry. Fundamentally speaking, it's very good. It's a loser, but in terms of growth and the ratios, it's a winner. Inevitably, I think this is an S&P 500 component within a year. And in my opinion, this is very high quality. So, like, why it's been sliding is two rumors, really. Out of the hyperscalers, they have Microsoft and Amazon as their customers, and Microsoft has chip delays as a rumor, whereas Amazon, there's just a bunch of so-called channel checks. They might have some sort of reliability to them that they're going to lose Amazon. So it is 100% true that if they, really, these rumors are true, they lose Amazon and Microsoft has delays. Like, this is that's a very bad scenario, to say the least. But, just thinking about it, and I was feeling a little bit emotional, right? And thinking about myself, like, every time I'm thinking, like, oh, this brilliant company is about to be wiped off the face of the earth, basically, which, like, these rumors really sound like it's that, because they're going to lose their two hyperscalers. Whenever I feel that way, I kind of try to use myself as a contraindicator. And in this sense, like, just feeling this bearish on MRVL and thinking, oh, like, this company's screwed, which frankly makes no sense. It's probably a reverse indicator. The channel checks, though, like, obviously it's worrisome, because you do think these guys say stuff with some sort of reliability, but at the same time, you never know. Maybe they're just trying to load themselves. A lot of weird shenanigans. And not too long ago, they had their kind of investor day style, an investor call, per se. And they said they're on track. And in fact, they're expecting to grow their market share somewhat significantly in the next couple of years. Obviously, they could just be saying that. You never really know. But they also had Jassy from Amazon, the CEO. They brought on one of his statements about working with MRVL. They had a VP at Microsoft come to just speak a little bit on their partnership. So, like, not that these things are extremely meaningful, but I would imagine to an extent that they probably don't lose both of their hyperscalers. But at the end of the day, you don't really know, right? Like, you're just trying to play the odds. So I guess that's just that. AppLovin here. I'm pretty bullish on this one. This one keeps getting stiffed on the S&P 500. And inevitably, it will be in. It's the largest component that should be in, but it hasn't been in yet. I think the reason it's not been in is because they have a lot of short reports. SMCI got let in, had really weird accounting stuff, got kicked out, and I think that's just kind of a worry for the committee. They don't really want the track record of letting in two companies that have basically done fraud. I don't think AppLovin's anything like SMCI. I think it's much better, very high quality, good management. Ultimately, it's kind of a sandbagger CEO, which is, in some ways, it can be good. I think it's good in this way. Something that I also point out is, like, this earnings was a beat. The stock jumped. And it's a pretty small beat, 23 cents. But the thing that's very interesting is they had to reduce their goodwill. And, obviously that affects the net income. But this is an intangible, so I think it should be ignored. If you actually smooth that out and normalize this isn't a tiny beat. This is actually a hell of a beat. So that being said, I think you're probably looking at $600 that's trading at 350 right now. And there's a lot of good catalysts. A lot of trash companies got in the S&P 500 instead of them. This one, like, I just have to feel that, like, it's more than inevitable. But anyway, we'll see. Want to bring up FEIM. I made a video in the low 20s, and unfortunately, it's down since then, despite, all space and quantum stocks being up. And in the video, I mentioned that there is kind of a double-edged sword for a company that actually makes money. They have a blowout quarter, as you can see, and the stock drops. Why? Because the CEO felt it was necessary to say that there will be volatility in the future, and it makes sense, they're in contracts. But you have some CEOs that will come out and say a lot more beautiful things than these guys, so it is kind of tough, the second you're actually making money, you're introducing real expectations, and it's pretty unfortunate in a market that's guided by animal spirits, I guess, as Drunken Miller would say. A company like Rocket Lab or Asteris, they're doing great, and someone like me, not so great, so slightly unfortunate on that one. But ultimately, like, this company is good in my opinion, and the balance sheet is good, so I remain long. Something that quite excites me, and I haven't brought this up in a while, is Hydrate. This one's pretty interesting. Last I talked about, I believe I said Victory Square is a little bit more attractive, and I still stand by that. As you can see, quite the volume increase. People are getting a bit excited. Something that, when I listened to their calls, was a bit concerning to me is it sounded like they were pretty comfortable with diluting, and there's nothing wrong with that necessarily, depending on the frequency and such, but dilution caps a lot of rallies. It's really hard to get those insane beautiful ones, and if management's actively trying to capitalize on it, it's pretty tough, so not great for an investor. They recently diluted again to purchase a portion of a pharmacy. It'll be great for the company, increase their margins. But I think right now, the CEO, the management team don't have a lot of shares. I think the fact of the matter is, in their position, the alignment is not to make the stock price go up, but it's to grow the company. And some of you guys might think, oh, that's the same thing. But that's not necessarily true. You can grow the company without growing the stock price. And if you look at any company, primarily Bitcoin miners is a really good example. You see the market caps are up huge, but the stock prices are down because dilution, right? I believe this company will use dilution to, just inorganically grow the company, right? And as the company becomes worth billions off of inorganic growth, the CEO pays himself more and it's more reasonable. Now, that's just the incentive side of things. So how can you take advantage of that, right? Because, if you're to go long this and the market cap 10 times is only because the shares 10 times, you don't really gain anything. So the way to capitalize, once again, brings me to Victory Square. Because Victory Square, their parent company, which is trading at quite a substantial discount to Hydrate, they have over half the shares, they have control of it, and they have a deal in place where they're receiving a 10% royalty on Hydrate's newest vertical, which is the direct-to-consumer one. And, receiving the 10% royalty on that new vertical essentially means as Hydrate dilutes, grows the business, but maybe or maybe not the stock price, what happens to their parent company is as the business is growing, so are the cash flows, right? So essentially what that means, if you're not understanding already, is that that's just a win for Victory Square. So if you're a high J holder, you may or may not win, depending on how they decide to dilute and what they're actually doing. But as the business grows, even if hydrate, even if they diluted at such a rapid rate that hydrate actually went down, sure, it hurt Victory Square's holdings on hydrates in terms of value, but just the 10% cash flow growing would be pretty game changing. And I guess something to also note is like a lot of holding companies trade at discounts, but the idea that this one trades at a huge discount but receives a cash flow is quite unique. So it'd be essentially the equivalent of Perishing Square trading at more than their current discount and receiving 10% cash flow from whatever they're holding. So it doesn't really make that much sense. And I think sooner or later the market will close that gap. Probably not fully, but I definitely think the gap will tighten. I guess the last one today that I'll mention is Robinhood. Robinhood's been riding pretty strong, partially because it has the crypto exposure and there's that kind of crypto idea behind it. Another thing is it passed the 100 level, which, I brought it up in a couple other videos, but it's been pretty recognized by a wide variety of people that when a company passes 100, 200, 300 for the first time, it doesn't just stop there. It's quite an arbitrary observation, but it's been reinforced by numerous people and even great traders like Jesse Livermore, who is once the richest man in the world, has came to this observation too. So it probably does have a little bit more legs. To be honest, their programs for crypto are doing a lot better than I expected. They had some sort of deposit match program that did really good. But that being said, still, I reinforce my idea that I don't think this is something that's worth holding into quarter two. The expectations, I'll admit, they're pretty low, but I think a lot of times when a company's stock prices run, the expectations aren't really the earnings, but they're significantly higher than that, right? So for what's going to be pretty mediocre numbers, still probably surpassing analyst estimates, but mediocre overall. And after a run like this, I just would be hesitant to understand that this could actually do well. Oh, and I just want to add one more after that, actually. PSSI is of a slight interest to me. I would like to get it at kind of the 18-ish level, but market conditions are really good. But this one is like SMCI without fraud, essentially, so that's pretty good. Valuation's it's decently demanding, but at the same time, it's probably worth the punt to an extent, although it is pretty low quality. So balancing that, I wouldn't chase it here per se, but I'm also the type of person who doesn't like missing out, so there might be good value in chasing that. But ultimately, speaking about the market in general, to wrap things up, you can see, it's very bullish, and while there might not be much room to go in the markets, it's this last kind of stretch of rally that often yields the most gains in crazy stocks. So it's hard to say if we're in that final stretch here. After the COVID recovery, that final stretch, you would have thought it probably would have ended earlier, but it really ran for a long time. So having just recovered, who knows, maybe we run for a year and things just get more insane. But a lot of companies that are pre-revenue are already trading in, the few $billion range, which is pretty absurd. So, and that's not even Meta, just getting AI companies. Some of these are mining companies. So pretty, well, I wouldn't even say pretty, extremely low quality pre-revenue companies that are even diluting shareholders, and they're trading in the billions. So with that being said, I would feel a little bit of euphoria is here, but I guess I'm not too euphoric to the point where I'm chasing, so maybe a little bit more to go. But ultimately, the market is pricing in Trump being on taco mode. So nothing's being taken seriously. With that being the consensus, I think it does actually make a good deal of sense to reduce exposure a bit, have some sort of cash for a potential correction, because, you know, come August 1st, will he chicken out? Most likely. But the thing is, that's already basically priced in. And the odd chance that he doesn't chicken out, or, you know, maybe he tries to hold stern for a week, there could be some decent decline. Like, he chickened out in April, but he took a while to do that. The market really forced him to do that. With markets at highs, I mean, he could be stern and just try to act like he's going to do something for a couple weeks, and the market, you know, could suffer even if it's like 5%. A lot of the high beta stocks, when they go risk off, like those are going to shed 30-ish%, 40%. So I think there is a decent amount of value in being cautious into August 1st. And anyway, like the market, there's not a whole lot of discounts on right now. Most of the stuff is like, it's pretty stretched. Not that it can't get more stretched, but if you're in the game to do analysis and like there's thousands of stocks, like there's no point of really chasing the ones that are already really stretched, unless for the sake of a trade, in which case there's nothing wrong with that. But yeah, I guess other than that, I don't have too much else to say, and I hope this in some ways is useful. If you have any questions, feel free to leave a comment.